What's going on, everyone? Caps and pars, everything's on the rise right now. If you've been monitoring your emails from these insurance carriers, you have been seeing nothing but rate increases. Again, this is the time of a lifetime of opportunity to capitalize on these high rates and to help your clients out with annuity-based products. Now, a couple things you want to keep in mind. You definitely want to make sure that these rates are going to be consistent. You have to research the company. You want to make sure that these are not just fly-by-night rates. Sometimes you'll see cap rates or par rates that are significantly higher than everywhere else in the industry. You might want to question yourself, if we're all fishing in the same pond as actuaries and all buying similar assets, why is one company so much better than the other company? Maybe because that first year rate is really attractive, but guess what? It can come down the next year and the following year and so forth. And if you're helping your client out with a 7 or even a 10-year annuity, think about that. They could have really good rate the first year, second, third year starts going down, down, down. That means that illustration that you shared with them is totally out the window. In addition to that, you might create some awkward conversations, but more importantly, that's a disservice to your client. They're taking your word that it's going to be at least somewhere close to what you showed them, and yet you sold them a product with the rates going down. Now, given we cannot control the rate environment, we can't determine what the insurance companies are going to do year by year. However, what we can do is research the company, see if they publish their renewal rates. Also, look for guaranteed cap and guaranteed par rate strategies. There's quite a few out there. Some are even based on the S&P 500 itself. Others are based on excess return strategies. I have a lot of confidence when I'm helping somebody if the company says, we guarantee we are not going to move this cap, this par, through the entire 7 or 10-year contract period. Now I know that based on my illustration, it's much more accurate than not having that, and if they can drop those caps and pars down. Believe me, if you don't research this and you start selling a lot of annuities, you're going to have some really, really awkward reviews. Now, given when it comes to income plays, it's irrelevant. It doesn't matter. If you're getting income annuities, the caps and pars, it doesn't even make sense, in my opinion, because you're buying it for a single and sole purpose, which is lifetime income. But if you're selling a growth product, you want to be sure that you stay within a 5 and 7 year window. 7-year window seems to be the sweet spot. It may not be as much compensation for you, but it's the right thing to do for the client. Because a lot of these 10-year plans, they don't have a guaranteed cap or par strategy for the entire 10 years. Or if they do, it's based on a really new or unknown excess return strategy. It's not based on the pure S&P 500, which creates a lot of consistency. But a 7-year strategy, there's lots of them out there that will say, hey, look, here's a guaranteed cap rate of 7, 8, 9, 10% on the S&P for the entire 7 years. And guess what? After 7 years, hopefully your client's happy with you, you get to help reposition it and move it to somewhere else. So I wanted to share this with you. Keep that in mind. Do your research first. Don't just sell a product because your upline or the IMO told you it was a good idea. They're probably just telling you to sell it because there's a big override in it. Think about the reasoning behind the recommendation. Do your own research. Your clients are trusting you.